Welcome to Module 3 of Week 7, where we're going to discuss deferral and minimization of state taxes. And this is basically a review of tools we previously discussed. The way the CFP board has set up the learning objectives. We have a series of learning objectives, and they've added this as another learning objective, but it's really a reminder of what we've had earlier, and let's go through that. It should be relatively straightforward because we've done it before. Application of the estate planning tools is critical if you want to be a qualified financial planner, is probably one of the statements that I should have at the beginning of the course. The tools that we have available are methods to reduce the size of the estate, methods to increase the deductions, and how to use the tax credits so that we can minimize, defer, or eliminate the taxes. Reducing the size of the gross estate, life estates, and we have full dominion control. If you receive an asset, if the decedent created the life estate, it remains in the estate. So again, if I receive a life estate from somebody else, that's fine. It's when I, as a testator, create the life estate that I have the problem. So what I want to do is eliminate as many life estates that I create for myself. Life annuities are good. Annuity, and many people have in a pension plan, is really an annuity, and you can buy them from private annuity companies. You can also, public annuity companies. You can also use a private annuity. I give assets away during lifetime and avoid retention of powers, controls, and reversions. And if you have them, get rid of them and try to live for 3 years after that. Lifetime gifting, gift of a present interest is an amount of the annual exclusion to a natural person. And again, the key that you forget many times is it's got to go to a natural person. If it goes to a charity or it goes to an association or a partnership, to a marriage, those do not qualify for the annual exclusion. It's got to go to a natural person. Use of estate freeze and the discount valuations for business and business ownerships, and use of lifetime gift exemptions. I might note also that we should be very careful on what we recommend as far as gifting. I would say that as a financial planner, I can offer the gift or have the client gift to friends and relatives who need assistance for charitable purposes. Also, if I have assets, or my client has assets in their estate that are very hard to come up with a valuation, I might want to get it out so I'm not subject to the estate tax. And if I have to minimize my estate. Other than that, there probably are no good reasons for gifting during lifetime. Reductions to the estate. Make use of the qualified deductions, and we've had a number of them in this course. Transfer unused portions of first to die unified credit to surviving spouse. Use of the adjustments in the gross estate to the extent authorized. Use the 10-year tax credit if applicable, and that again is if someone dies, these assets to another, and that second party dies within a 10-year period. And then finally, use the foreign tax credit. These will all help reduce the taxes on a qualified basis and are all the things that we can plan for. Valuation discounts, make sure that you use the discounts if applicable. And if you don't, I'm sure your tax preparer for after death will, but many times it's a good idea to use this when you're gifting, obviously. Minority interest and lack of marketability, certainly when you're giving gifts to your children or grandchildren. Key personnel, if you have a business. Contractual discounts are another one, and we've covered some other ones, but these are probably the main ones you're going to run across. Minority discounts. Minority shareholders who are unable to influence corporate actions are eligible for the minority discount. It applies to closed corporations and those not on an exchange, and it results from the complete lack of control on their corporation. And that, so if you're the son of the owner, it's not going to be the same as someone who's not the son of the owner. In other words, we have to, as part of coming up with how big the discount is, look at the relationship between the parties. Lack of marketability discount allowed for shareholders in a closely held corporation or partnership. Results from a very limited market for the shares of the partnership or the partnership, which if you have no control and it's a closed corporation or partnership, you're not going to be able to have any guarantee you're going to get anything out of it, so you're going to pay very little for shares or partnership. Key personnel discount applies to companies and not individuals. Reason for discounting impact on the earnings and difficulty in hiring a replacement. That is relatively few people in a company usually. It's usually the owners and the general managers and maybe vice president levels. But certainly if you're a family-run company, this is a big help for not only providing that, but also providing the funds needed to allow one of the children to buy out the other children, their siblings, when it comes to buying out the company at the death of the parents. Benefits from continuing ownership by the family. Well, we have code sections 2032A and 6166, which require family members to continue ownership and management of farm or business for an extended period of time. And so if you're willing to be that 10 or 14-year period of continuing management, you get tremendous tax advantages. Failure to do so, however, results in retroactive payment of the taxes and thus penalties and interest, and it cannot be sold to non-family members and thus a discount at death of the individual. So let's say that there's 5 siblings that inherit under either one of the code sections. One of those siblings dies during that 10 or 14-year period. Again, we get a very big discount because of the lack of marketability, the sale of that share of the business, because it cannot go outside the family. That is it for week 7, and good luck on the quiz, and then we'll see you next week on week 8.